8:34, we'll convene the Board of the Retirement Association.
Sorry.
Patrick, want to lead us in the pledge?
Right.
I just got situated in this chair.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
So the first thing on our agenda is public comment. Members of the public are welcome to address the board for something both on and off the agenda. Any public comment? Not seeing it, we'll go to the consent calendar. Matters in the consent calendar approved by one action without discussion unless the board member requests separate action. We have the minutes of April 18th, retirement report, quarterly trustee education and training report, and monthly preliminary financial report. Do you have any discussion on the consent calendar? If not, they'll be approved without
By unanimous
by unanimous consent. Okay. Then we go discussion possible action regarding the investment matters. We have the quarterly investment report.
Okay. Greg, you're up. This is my cue. Thanks, Tim, in case Richard comes. All right, great. So I'm going to talk to you about first quarter performance today. And we don't have a lot of other items, so it's kind of a light lift from an investment perspective today. But I'll keep in mind that we went through a lot of work over the past couple of years coming up with an asset allocation and did a number of searches. The last few managers you hired included in the international equity side, your emerging market equity manager and your dedicated international small cap manager. So now we set up a lot of the program and we're monitoring it to make sure it's performing as we had anticipated. And the short answer is that it is. And while we did experience a turbulent market in the first quarter, and some markets were down for the first time in a long time, you actually performed well relative to your target. And we'll see that relative to your peers, your performance is also pretty strong right now. So overall, it's a bit of a mixed message of that the quarter was kind of tough, but you're doing well. Before I get into the markets and your portfolio, I'll give you a quick update about Callan. So during the quarter, we announced that we have a new president and head of fund sponsor consulting. So Callan is structured as a employee-owned firm. A number of us are all shareholders. I happen to be a shareholder of the firm. About 40% of the firm are shareholders. And we have a chairman, Ron Payton, who many of you have met or seen at our conferences, and James and Stan saw him in our office just a few weeks ago. Ron has been our CEO for a long time and is chairman. And about a year ago, he appointed Greg Allen as our CEO. So you all knew that already. So Greg was CEO, and he had the title of CEO, Chief Research Officer, and President. And that's too many titles for one person, right? So he assigned the president title to Jim Callahan, who's my boss. He's the head of fund sponsor consulting. So Jim is now the president of our firm. And then the head of fund sponsor consulting is a woman named Millie Vaquera, who works in our New Jersey office. So Millie is the new head of fund sponsor consulting, and within that we have 5 offices, San Francisco being one. That's the office that I manage and that we service you out of. All of this is stuff that we kind of knew long ago. This was the succession planning that has been set up for a long time. So it's not a lot of news for us, but it happened, and these sort of things happen to us once every decade, so I thought I should bring it up to you. The other thing I'll bring up is that Stan and James came to our office a few weeks ago, and we had a great 2-day meeting where we sat down in depth with all of your managers and had a check-in with them. We covered 8 managers, all but one of your international equity managers, your real estate managers, and one of your fixed income managers. And I think it was really time well spent to walk through all of their portfolios in depth individually. And it's great to just spend extra time with Stan and James in that regard too, to get a feel for what's going on in the portfolio and things that we could work on going forward. Now naturally, these are managers we cover all the time, but we did have our research specialists come in. I thought it was great for Stan and James to see some of our additional research specialists. We have about 40, and it's just their job to follow these managers and come up with our opinions and assessments on them. So that's the other quick update I wanted to share with you. With that, unless there are questions, I'll, as I normally do, I'll give you a quick snapshot of, from our perspective, what's going on in the economy, what happened in the capital markets in the first quarter, and then that'll help you frame, okay, how well did we perform? So from an economic standpoint, the first quarter we came in with a GDP growth of about 2.3%. This was a little more than what people thought it would be, but it was a little less than what we had been experiencing a couple of quarters of 3% growth towards the tail end of last year. So good solid growth, but not at that 3% rate that everyone kind of hopes and talks about. Consumer confidence remains high. So in general, at least through the end of the quarter, consumer confidence was high, and that's a good thing because consumers contribute about 2/3 of our economic growth. So when they're buying things, our economy tends to grow. Part of the reason that their confidence is high is unemployment is really low. So at the end of the quarter it was 4.1% since the quarter end, and we saw like last week it came down to 3.9%. So unemployment is quite low, and it's at a point where we should expect wage inflation to pick up. And in fact, we did see that just tick up a little bit. Just a little, and people get excited about these little tiny pickups in February. And that is what led to expectations in the bond market that the Fed will be increasing interest rates. Because if you have inflation coming up at the individual level through wages, that is where you get persistence of inflation. And the Federal Reserve wants to get out in front of that. So in February, the market said, okay, the Fed really is going to be increasing rates 3 to 4 times this year. And we believe them now, so yields went up across the board. So the 10-year Treasury was up about 40 basis points, the 2-year Treasury was up about the same. And these small changes in bond yields have a effect on the price of bonds. Of course, yields go up, the price of bonds go down. But because there's so little yield in bonds right now, a little bit of price movement erodes all of the income you get, and you get negative returns in fixed income. Just that little 40 basis point increase across the board, because there's so little income right now to overwhelm the capital depreciation. So you see we had what I would call a tough quarter in the bond market. It was down over 1%. I think 30-year bonds were down about 4%. But keep in mind, I mean, a bad quarter in the bond market, I mean, that's a bad day in the stock market, right? I mean,
Yeah. Yeah.
So, I mean, you kind of need to look all of these things in relation to each other about and consider volatility. Anyway, so the Fed did increase the federal funds rate for the first time under the new chairman, and we do expect that they'll increase rates another 3 times throughout the year.
It's a great question. Are they also thinking there may be an increase in the rates if there are tariffs? I mean, I've heard that tariffs lead to higher consumer goods prices, and that could also trigger.
Well, tariffs are a tax, and taxes are often passed on to consumers. So the things you buy, tariffs very well could lead to higher prices in the things you buy. So that would lead to inflation. And if you have a lot of inflation, then the Federal Reserve might be interested in reducing inflation, keeping inflation contained, and that would cause them to increase rates more if we have more inflation. And there are other things that are leading to concerns about inflation right now. And when we say concerns about inflation, I don't want to, it's not the 1970s, it's not double-digit inflation, it's not high single-digit inflation. It's just, 3% inflation would be hard for our economy. There are a few things building to inflation. One is, you mentioned tariffs. The other is wage inflation. But then if you look at oil today, oil's at $71 a barrel. And, oil still is a meaningful impact in inflation across the board for us. The impending trade sanctions on Iran could also lead to higher oil prices. Some people are speculating that there could be a war premium put onto the price of oil if you think there's going to be more instability in the Middle East going forward. Saudi Arabia said they'll pump out as much oil as you could ever get from Iran. So they're saying there's not going to be, we don't have to worry about that too much. But if there is conflict, then that naturally the price of oil would go up.
How are these interest rate changes going to link to the strength of the dollar?
Well, it's the most direct impact is that if we have a higher yield here than overseas, people will want to put their money here and get that higher yield. So that is generally supportive of the US dollar. So capital flows should come into the United States if we have yields higher than internationally.
And that in turn puts pressure on rates downward?
That's right. And that's a great point.
Circular, is it?
It is. So our yields are higher than they are in Germany. And if people in Germany want to put safe money somewhere,
Why is that?
why are our yields higher?
Yeah.
Because we have a higher growth rate. And the cost of money is higher because of that. So yields are essentially just the cost of money. How much does it cost to get money? If there's a lot of money and few ideas and few opportunities to invest, the price of money goes down.
Is most of the money in bonds by dictate? I mean, investors with free will could go wherever they want to. Are bonds propped up by the ECB?
Well, the federal, Japan, United States, and Europe all have gone through this quantitative easing thing where they have bought a lot of bonds. And the U.S. balance, they're going to be selling about I think it's either $500 billion or $1 trillion a year for the next 5 years of treasuries. So they're holding a lot, and that's going to be coming off. So there are a number of non-economic buyers in the bond market, people who buy bonds because they have to, whether it's a central bank or it could be an insurance company. There are these rules about what an insurance company can and cannot buy so that they're not too risky, right? So, and their banks have the same thing. So the Basel II and other regulatory standards that apply to insurers in the United States and Europe that forces them to buy bonds. And so they will buy bonds and hold them to maturity and live off the yield of it. But they can't take their portfolio and buy a bunch of stocks because that's too risky as you as a depositor to put your money into those financial institutions. I don't know if that answered your question.
Oh, thanks.
Okay, about that, I hadn't noticed this before, but on page 2 of your report, it shows global fixed income with a 8.5% return for the year.
Yeah,
Is that highly unusual, or do they usually do that?
that's unusual, and that's currency. So it's not that the bonds in local terms have made so much money. It's actually that if I would have put my money in a European bond, and then the US dollar depreciates by 8%, I make 8%.
Okay.
And that's really what has happened. The currency impact has been meaningful. Actually, since Trump was elected, one of the ironies is that the US dollar has fallen meaningfully. And that has benefited international assets. If you're a U.S. investor owning international assets, the currency is appreciating of those assets that you hold. So in the quarter, for example, international stocks were down about 1.5%. For a U.S. investor, if you were a local investor, meaning someone in those foreign countries, they were actually down about 4 to 5%. And it's just that the US dollar fell about 3% that it got back to that 1.5%, only a 1.5% loss. So currency is the explanation there. One of the other broad themes is the concerns about trade policy, and there were talks about trade wars with China and all of that during the quarter, and that led to some uncertainty in the stock markets as well, not only rising interest rates and concerns about trade. So that, at one point in the quarter, the stock market was up about 8 or 10% and hitting all-time highs, and then February came, volatility spiked, and I think I was meeting with you right around that time. And then the market gave up all its gains and ended the quarter down modestly. In general, most tech companies and growth-oriented stocks tended to do well during the quarter, with a couple exceptions like Facebook and Google, who had their own individual issues with potential regulatory issues due to the Cambridge Analytica scandal, and what's going to change with the business model of these companies going forward. Outside of them, tech did well, growth did well. So when we look at your portfolio, all of the equity managers that made money, they were your growth-oriented managers. Things that didn't do as well from a stock perspective were those things that were linked, those stocks that are affected by changes in interest rates, utilities and REITs, and then actually energy companies didn't do too well. I bet energy companies are doing pretty well today. So this very well could flip. Your value managers tend to own REITs, utilities, some energy, because they're looking for cheap assets, right? Or income producing assets. So maybe next quarter, maybe this time when I'm sitting here next quarter, this story is going to be reversed. Excuse me. As I mentioned, yields increased meaningfully across the curve. And within real estate, I mentioned that the REIT market sold off, and depending on what REIT index you look at, so these are public companies you can buy, which then go on and buy real estate. They were down between 4 and 8%, depending on which ones you look at. And that's because a lot of people were buying these REITs as a surrogate for a bond, saying, oh, I'm getting income from this, it's like a bond, I like the dividend. When yields go up, everything that competed with bonds looks a little less attractive because you can just put that money in a bond now and make a little more money. So that's one reason that REIT sold off. Within the private real estate market, and that's where you have your money, it produced another quarter a positive return, but a lot more of the return is coming from income now as opposed to appreciation. Where you go back 2 years ago, you see 12% returns for real estate. That's appreciation driven. It's not income driven. So going forward, we should expect lower returns, one, and then also that it's more driven by income. Okay, so I'm going to flip to page 8 here. And on page 8, we show our asset allocation. So this is how much money we have allocated to each broad bucket: bonds, stocks in the US and internationally, real estate. And the big picture here is that these two pie charts look a lot alike. So Stan and James have been rebalanced the portfolio close to target. And we do have another hard copy.
Oh, no, I'm fine.
You okay?
Yeah, okay, thank you.
So Stan and James have been rebalancing close to target, and we think that's a good thing. Disciplined rebalancing, if you do that, you sell things when they're high, and you buy things when they're low. Doesn't always work with a continually trending market, but we can't expect markets to always trend in one direction. So your asset allocation is quite close. I'll spend a quick second here and point out that you have an 11% target to real estate. So, and you invest in 2 core open-ended real estate funds, Reef and Barings. We've been keeping a close eye on Barings, and we met with them, Stan James and I did, when they were in our office a few weeks ago. We're thinking about, well, what should we do with them? Because they had a portfolio manager change, they had a few redemptions that looked a little high, and performance has been not awful, but kind of middling. We've been working on a search to say, okay, what other candidates are there out there that you could invest in? And so Callan's been doing that work. We've narrowed the list down to a handful of candidates for you to consider. But I think we also could take the opportunity to look at other real assets in this category. So real assets are investments that are made in real property, things that are tangible, real. That's one meaning of it. And the other meaning of it is that they tend to produce a real rate of return, a return in excess of inflation. So they should protect a little bit more, act a little bit differently in times of higher inflation. So I think we should do some research and bring back research to you and information to you about other things you could be doing in the real asset category. So that could include things like timber or farmland or infrastructure or something like that. So something else to diversify that real asset bucket a little bit more, instead of, if we would make a change at Cornerstone, just flipping another real asset fund. So this is more of an educational session, and I think in the coming months or quarters, whenever we have time and can get it on the agenda, we can bring back some information to show you what some of these other things are that you could consider. Okay, on page 9, this is where you see the bottom line. Okay, how much money do we have? And at the end of the quarter, assets stood at just under $520 million, down net about $1 million from where you started the quarter. You actually made about $1 million in net returns. So, which is actually surprising to me. I thought we would see a negative return. But you actually made money. And then you had net new investments, so money leaving the trust for benefit payments of about $2 million. So if you look at that investment return column, where did you make money? Anything that's in black as opposed to red. Domestic equities, you actually made about $1.4 million, surprising in the down equity market. All of the managers that are in the black are your growth-oriented managers. So Harbor Capital Appreciation had a really strong quarter. That's the fund sub-advised by Jennison. It's a large cap growth fund. Janus Enterprise is a mid-cap growth, and your small-cap growth fund by Alliance AB all produced positive returns. Everything else was negative. In international equity, you had modestly negative returns, loss of about $240,000. And then again, your growth manager, Europac, did well. But also international small cap and emerging markets held up pretty well in the quarter. So those two strategies we picked, they offered a little bit of risk premium and a little bit of diversification. And they produced some positive returns through the quarter. Bond portfolios were negative across the board. As I mentioned, yields increased. Now, thankfully, both of your bond managers, PIMCO and Dodge & Cox, have been defensive in their view on interest rates. So they have been underweight duration, Dodge & Cox meaningfully so. So when the bond market sold off, they didn't sell off as much. Okay? So they did produce positive, negative returns, but it wasn't as bad as if you held an index fund. Okay? So the active management paid off here. And then finally, in private real estate, you earned about $1 million in that asset class. So, flipping ahead to page 11, the total fund for the quarter, it was, so this is a time-weighted return. What was my return, Greg, regardless of when money was coming in or out, time-weighted return? It was up about 20 basis points for the quarter, and your benchmark was down about 67 basis points. So you outperformed by 0.8% in the quarter. If you look at longer time periods, we've achieved about a 7.3 to 8 point something percent return over the last 3, 5, and 7 years. This is higher than we told you could have done. So I think we should feel fortunate that these are our returns. They're higher than what we thought they would be. For the time periods we're looking at here, you have outperformed your policy benchmark. So that's a good thing overall.
How do you get the return for King's Court? What's high for the years here?
Yeah, so we get a net income number from Stan on a quarterly basis. So how much revenue are you taking in? I think you lease part of the other side of the property. And then there was a revaluation in the property's value last year. And that's why you're getting that 25% return, because the property was revalued. And I forget what your standing process is of how often you're valuing that, but
It's either every 3 or 4 years.
yeah. So the return is high, but keep in mind that the property is it's valued at $1 million, so it is 0.2% of your total assets. So it has very little impact on your total portfolio.
If we own real estate, we have to have a qualified real estate manager manage that asset for us? I don't believe that's the case with this building. Where do you draw the line? Like for this building, we manage it ourselves versus a qualified manager, investor manager for other real estate. If we bought the building across the street, let's say. What can you tell us about that?
Well, I think different organizations treat it differently depending on the size of their staff and their ability to administer and manage a property. my observation is that there are other public entities that just own the building they work in. And then they don't buy other properties direct. There are some organizations that say, I don't even want to own the property I operate in, I'm going to pay rent, right? And I'm just not in the business of managing real estate. I would say that's actually the most common one. And then the third model is where you have a large staff and you're willing to pay your lawyers to do work or hire construction companies that when renovations are needed to own other properties. But you have to have an infrastructure to do that, and you need people on staff to. You need good team members to help you execute things. You need relationships with brokers, and also, I mean, it's quite an undertaking. So where we see that are the very large state plans that have very large staffs to doing it.
Well, I mean, let's be a little more specific. Let's say that we wanted to forget about the development part, but we wanted to own a 100-unit apartment complex next to the junior college that would be master leased to the college for student housing. We thought that was a good idea for the community and a sound long-term investment. Who would we be required to have manage that? Could we manage it ourselves? Would we hire a property manager who does all the nuts and bolts stuff and call them a qualified investment manager? Or could we do it ourselves? Where does the rubber meet the road in, let's say we wanted to own a 100-unit apartment building in Ukiah?
I don't know what your legal requirements are for that, and I'll defer to Jeff if he has an opinion on that.
No.
So there's no law that says you shall have a certain person manage your property, but if you're negligent or you're not satisfying your fiduciary obligations and the property value goes down, I mean, it's more, I think, a reasonableness test.
Oh, okay. But some people at
I'm not aware of any law.
Only any, or they made it sound like any asset you had to have a qualified investment manager.
That's best practice. I would say that's best practice, where you have an arm's length relationship with your investments.
Right, with your tenants. We're not calling up the tenants for the rent. We have a property
Nor are
manager
they
who
calling
fixes the
you
roof.
to
Right.
say, I'm a teacher and I make $30,000 a year, and why does my rent go up 3% a year?
Right.
The phone calls go both ways, and so I would say best practice is that you have an arm's length relationship, and that's probably especially true in a community where everyone knows each other. I would see that being tough. So part of what we're talking about is governance. Okay, what's a good governance structure for us to manage assets for which we're a fiduciary, right? So that's what I think we're really talking about there. Now, I'm an investment consultant, so what do we think about that as an investment? That, to me, that's a different topic. And the struggles I have with it from an investment perspective is you aren't as diversified because the ability to get money into this plan is based on local taxes, essentially, right? And then if something happens to the economic base here, it also affects your investment here. If you have a property here, right? So then you're it's almost like working for General Electric and putting your money in company stock of General Electric. Where you get your money and your investments are the same thing. So if one goes bad, both go bad, and then you're in trouble, right? So there's a diversification argument about it. Could it be a de minimis investment for you where it doesn't have an impact, perhaps, that you could make that argument? But that's something that I would
Yeah,
think about.
like I used that as an example as basically a community infrastructure investment.
Yeah.
Versus, we're not gonna loan on somebody to build a drive-in movie theater or a strip mall or something like
Right.
that.
Right. Any other questions about? Okay. So a couple of things I point out on pages 10 and 11. Maybe I'll just spend a minute on a couple of the managers that we're keeping an eye on. On the domestic equity side, pretty much they're all looking really good right now. So no big concerns. On the international equity side, the one manager who is disappointing is Harbor International. So we actually met with the Harbor team who has a sub-advisor named Northern Cross in here. And they have struggled performance-wise, so we're keeping a close eye on them, but we have no recommendation for you to take action at this time about them. Mondrian has also underperformed, and we did spend some time with Mondrian as well. They focus on securities that are dividend discount, that pay dividends, right? And that hasn't been as popular, this value-oriented strategy. So style explains a lot of their underperformance. So we have no recommendation to change them. But I just want to acknowledge that these two managers aren't meeting our expectations right now, and just let you know they are on our radar screen. The other manager is the one I mentioned, the Barings Core Property Fund. And we met with their portfolio manager, and actually I went away after meeting with him feeling much better about the fund, but we still need to keep a close eye on the investment. So, yep.
Under domestic equity, we just have a total, if we lose track, how many different managers do we have under domestic equity?
How many managers?
Oh, I'm sorry, I was reading that wrong. That's the total of all of those below it.
Oh, where it says domestic equity, 68 basis points?
Yeah.
Yeah, so that's your total domestic equity portfolio. If I wrapped them all up, what did they
Okay,
return? Yeah. And that's actually a really, really good story, that in aggregate they all performed quite well. Flipping ahead, let's look at page 18. And what we're looking at here is your performance, the green dot, relative to other public funds in our database. And the triangle is your benchmark. So all the time periods we're looking at here, quarter, year, 2, 3, 5, you're ranking well relative to peers, the top quartile across the board, and you're above the policy benchmark too. These are net of fee returns. So you're looking good on both measures, whether relative to the index and relative to other public funds. The bottom chart, this gets a little geeky, so bear with me for a second. The bottom chart tries to answer the question, okay, why are we doing well? Is it because of our asset allocation or the managers that we're picking? So what we do here is we say, what if everyone else in the Callan database had your asset allocation? What would have they returned? So you see here that the bars change and the bars narrow, and they look more like one another because you're taking asset allocation out of the effect, the impact. And the story is that over the last few years, you're still ranking really well, which means that it's also the managers you're picking. It's not just asset allocation. It's also the fund managers have done well for you relative to what other fund managers have done for other plans. So, pretty good story overall.
So that's a Callan attaboy on that one, right?
Well, we help you with everything, but we're a non-discretionary advisor. You guys can take all the credit. Fiscal year to date is on page 21. And let's see, we've got one more quarter to go in the fiscal cycle. Right now you're ranking well, so hopefully this quarter will hold up and your rankings will stay competitive. The one thing I was happy about in the quarter is, one thing I've always shared with you is the belief that your fund is very pro-cyclical. When the markets are up, you do well. When the markets are down, you don't do as well. So the markets were down last quarter and you actually did well relative to others. So that challenges the simple thing I just shared with you. So I was happy that your manager's protected in that down market. So hopefully that holds true going forward. I'll flip ahead quickly and look at your broad asset classes. I think that's a good thing for you to focus on as opposed to always getting caught in the weeds of the individual manager. But on page 23, this is where we look at your domestic equity composite. This is what Tim was alluding to. So these are all of your U.S. equity managers. And here the dot is you. The peer group are other public plans, domestic equity portfolios. And then the triangle is the Russell 3000 index, your policy benchmark. So it's a broad, it's the 3,000 largest stocks in the United States. So pretty good story across the board. Your performance ranks well, but you're also beating that policy benchmark. So active management has actually paid off for you in this area. And this is even with us having your largest managers are index funds too, right? So it's not that we're taking all of this risk in active management. We've got both active and passive. So pretty good story overall. And if you ever wanted to, you can flip through the pages here to look at the aggregate portfolio characteristics. I always look at this. I won't bore you with the details. On page 52 is your international equity composite. This chart is a little more challenging for us, in part because we had some managers who we let go a little while ago. The Janus Overseas Fund, remember? That fund was a much more aggressive fund with high allocations to emerging markets and had a couple of idiosyncratic individual stock picks that went against them. So here, if you look at this, you say, okay, we're performing similarly to our benchmark across the board. And over the very long run, we're above average and beating our index. But we've had our struggles in years 3, 5, and 7. Overall, we're pretty close to the benchmark, but other plans have done a little bit better. Their international equity managers have done better. So ranking in the 70th percentile, 60th percentile. So I think this is one area where I wish we had done a little bit better. Luckily, we have a lot more money in domestic equity than international equity. So the international equity is domestic equity is counterbalancing it. On page 82, here we look at the bond managers, and you've significantly outperformed the benchmark. So the green dot is well above the triangle across the board. And relative to other plans, you're about average most of the way. The dispersion of returns within fixed income is much more narrow. So these bars look big, but take a look. I mean, we're talking about a couple percentile difference from one another. There's bigger differences when you look at the other asset classes. And then finally, with real estate, we just have the individual managers, both of whom on pages 92 and 93 have performed pretty close in line with the benchmark. and have done a reason. Reef in particular has done well for you over the long run, being top quartile. And then we talked about the Barings Core Property Fund has not done as well relative to the benchmark over the long run. One odd thing about this benchmark is it's really it's a combination of other core open-ended funds. So it's really the average of the peer group. And this might be a detail that you don't care about, but it's something I struggle with a little bit. You can't just fire a real estate manager and buy an index fund. You've got to pick another manager because just the way the market is. And that median isn't really investable. I guess that's the point I'm trying to make. So overall, a pretty good report card. And final thing I'll point out is that, so domestic equity, we're looking good, bonds, we're looking good, real estate, we're looking decent, international equity. In investing, if you get 60 to 65% of your investment calls right, you're a winner. If you get 70% right, you're Warren Buffett, right? So I'm never going to come into here and give you a report and say that everything is perfect, right? And if everything is perfect, you only have one investment, right? There's some sort of weird correlation thing going on, right? So it's actually okay if you have a couple things that aren't working perfectly right now. It's okay if you have a couple things with negative returns, if you have more things with positive returns. It's just the nature of investing, where you really want to win 2/3 of the time. That's our goal. Okay. Any questions?
I've got one. I don't know that I've ever asked you this. This whole issue of social investing.
Yeah.
I'm particularly leery of it. The tobacco PERS analysis is probably a good case in point. Do you have an opinion on? There's a lot of it ebbs and flows, but it seems like we're in a period, at least in California, where there's a big push for that in the public pension realm. Less so, it seems, for 37 Act plans. But I'm curious if you have an opinion, or Callan has an opinion on that.
Yeah, I'm sorry, but you missed our education session a couple months ago, where we walked through ESG and we shared with what we're seeing other investors do, and one way you could look at the market. And I would say that there has been a lot of talk, and of late it's been about firearms, weapons manufacturers. After the Parkland shooting, there was a lot of talk about that. And I think it comes down to if you have an inclination to have a mission statement, a social mission statement. Some people do, some people don't. And then what do you do with that mission statement? Do we engage with our portfolio companies, or do we divest from portfolio companies? Engagement takes a lot of work. To engage with them to say how they should be operating their company, you need to sit down at the table and talk to them, have access to them. It's work, it's labor. Or divestment says, I just don't want to invest in that company ever, and take it out of my portfolio. We have investors who do both or none. And it really comes down to the organization and their philosophical belief, and if there's a uniform alignment of an organization and their investment. So what do I mean by that? If I work for a Catholic organization that has a pension plan, or a medical system owned by a Catholic organization, they had pretty strict, clear values, if you will, and they're going to not invest in certain things that other people are willing to invest in. So it becomes a little harder where, okay, what is the value of another corporation or a public entity or all of that? So I can't advise someone on what their values are. But if they tell me what they are and they want to invest in a certain way, I can tell you how to do that.
Are you seeing more plans, move in that direction? And is it more on the private side as opposed to public plans, or is it a little of both? Or?
I think it's a little of both, but probably more on the public side than the private. Yeah, unless the private entity has a set mission that drives their investing behavior. For example, what if you are a healthcare company and you want to control your cost and you think tobacco leads to your costs going up? It's kind of easy for them to say, okay, I don't want tobacco in my portfolio. So that's where I might see it in a private organization. But we've seen, so I had a guy named Mark Wood come up here and talk about it, and he went back to the history of them. This goes back to the 80s when I was in high school, and it was apartheid, right? No, I'm not going to play Sun City. That's where, so it's been going on a long, 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 long time. And it goes through ebbs and flows of interest. Yeah, so I guess that's kind of a convoluted way to try to answer.
Wouldn't it be hard to do for us because we invest in mutual funds?
Well-
We cannot tell a mutual fund don't invest in X, Y, or Z.
Thank you for that, Tim. That's a great point. There are some funds you can invest in which have social screens or some sort of screen, but would you put all of your money there? It wouldn't. No, because I wouldn't recommend you give all your money to any single manager, right? Not just that strategy. Yeah, that's another real practical limitation for you.
And you missed my input. CalSTRS does not invest in any tobacco, and it cost us $1 billion when you sat down.
Crunch numbers there. Yeah.
I thought I had heard CalPERS lost.
PERS,
Well, you talked about apartheid, not investing in South Africa many years ago, and they've lost billions of dollars because of that.
God, very important to us.
So we have a 9:30 timed item. If this is over, maybe we'll take a short break.
Yes, sounds good. Okay, great, thank you. Oh, one other thing is, so most time we share the monthly report, it's not quite done yet, right? Because the meeting's pushed up for CalPERS, or SACRS. Next week's SACRS is when you would typically have this meeting, so we'll get that report to you as soon as we can. Okay.
I think it's great.
Yep, thanks.
Thank you.
All right, yeah.
Good.
Thank you.
And thanks for calling College.
Was that a good use of time?
Yeah, very good use of time.
Oh, good.
Very good, should have been there. Oh, good.
Same one.
Yeah, it's very good.
More
Thank
things
you.
in your
Yeah,
neighborhood.
and we're now on item number 4, which is discussion and possible action regarding the 2018 actuarial review of the June 30th, 2017 actuarial evaluation and the June 30th, 2016 actuarial experience study. James, want to?
Thank you, Mr. Chairman. Trustees, we do have our consulting actuary and the auditing actuary on the line today, participating via WebEx, taking advantage of technology to reduce costs as much as we can. They are currently on mute. I will unmute them in just a moment. And so the auditing actuary is leading the discussion. They will be walking through their audit report, and they're available to answer any questions we have. The consulting actuary submitted a response that you have in your board materials as well. Are there any questions of me before I turn it over to Graham Schmidt with Chiron?
Will they assume that we've read it and moved
I
to the facts?
I can make that point to them very, very plainly. So, all right, Graham.
Yes, how are you?
Great. All right, we are on your item, and we'd like to turn it over to you. And the direction we want to provide is that we've all had the material and we've all read it. So you can give us you can start with that assumption that we've all read this, so you don't have to walk us through every little detail. And with that, we'll let you guys take over.
Graham. Graham, if I may. So this is Andy, and I'm dialing in from Seagull with Andy, with Andy.
My apologies, Andy. I did say that you guys were on the line. I did inform the board of that, so.
Okay. Great. Well, thanks, and I'm flattered that everybody has read the material. So thank you very much. I will try to keep this brief. And helping me and keep this brief is the fact that this is a very clean audit, so you can be comforted by that. I was up there, about 7 or 8 years ago, giving much different results of an actuarial audit. So this was a lot easier to put this report together.
We've stopped passing the
Just want to
buck.
let you know that at the highest level, we were able to confirm the liabilities and costs. So we were within the margins that we were expecting to get or hoping to get in terms of matching our parallel valuation results to Siegel. We do have a couple comments on the assumptions, most notably the mortality assumptions, and I'll take you through some of those comments. But if we could jump right into the presentation or into the report, if we go to page 3, table 2-1, the table is down there. This really summarizes our parallel valuation. So as part of this audit, we collected data independently from the system as well as from Siegel with their process data. We set up programs ourselves to model your system and ran our liability results, compare them to Siegel's, and we found that within the actual accrued liability, we were within 0.2%. The unfunded, we were within 1%. So the funded ratio is also very close. And in terms of the total employer contribution rate, we were also within 1% of Siegel's. So their result was 34.92% of pay. Ours was 34.62% of pay for the 2017 actuarial evaluation. That is well within the desired tolerance levels of an audit. So you can be comforted that it appears Siegel has done the calculations appropriately. If we turn right up to the next page, we also looked at the liabilities and costs by the individual tiers. Again, we're shooting for a match within 5%. There are two groups here, safety tier 3 and probation tier 3, where the accrued liabilities are off by more than 5%. However, that's not a concern for us. The reason for that is that those two groups are the new PEPPER groups. And the average amount of service for those groups, it's only 2 years or 1.5 years for the safety and probation, respectively. When you have different valuation systems, they can operate differently in terms of how you would round, say, an entry, the age at which somebody is entering the system, rounding years of service, whether it's using precise decimal years or rounded years. So we are used to seeing differences of more than 5% when you have very new tiers, right, where they only have, we're talking about the accrued liabilities, so the only portion of the benefit that we're talking about is that which has been earned on that, 2 or 1.5 years of service. So we're used to seeing larger discrepancies for very new tiers just because different systems can operate differently in terms of how they round things. If we turn to page 5, table 2-3, what we find here are the contribution rates, and we find that even for safety tier 3 and probation tier 3, our contribution rates, which is a combination of the normal cost plus the amortization of the unfunded liability, those are still within 5%. So even though we do have a larger than 5% difference in the accrued liabilities, the total cost is still within 5%. So we're not concerned about that with respect to the match. Also on pages 5 and 6, we describe how the employee contribution rates are, we recalculated those ourselves, and we found those to be within our desired tolerances as well. We also reviewed the data both from MSERA and from Siegel. We looked at the data questions that Siegel had provided to you, and we found that our match of the raw data versus Siegel edited data looked reasonable as well. So that really sums up our match of the valuation. Our pause here and just ask if there are any questions before we move on to the experience study review.
I just have one question on, what table was that? I went too far. This one? Yeah. So on this one, on table 2.2 or 2-2, so I'm guessing it's maybe because the safety and the probation tiers, there's a higher benefit there. I mean, the formulas are different, but the general tier 4, which is also PEPRA, that is at, really high, but yet the safety and the probation were not quite there. Just curious as to did that have to do with the benefit being different for safety and probation?
Why the actual dollar amounts are higher?
Well, the percentage, just the difference in the percentages.
Why is there such a close
So for-
match for the general tier 4, but not for safety tier 3 and
Sure.
probation tier 3?
For general tier 4, you just have a larger group. So the larger the size of the population, the more these differences in valuation systems will tend to even out. Safety tiers 3 and probation tier 3, you have very small populations in those groups. Actually, I don't have the number in front of me, but as you can see by the liabilities themselves, you've got about 5 times as many people in general tier 4 as you probably do in safety tier 3 and probation tier 3. So with a larger group, you tend to have a closer match, even given these differences in rounding.
Okay, thank you. That makes a lot of sense.
Okay, we did have one comment with respect to the data. We know that there have been different data amounts provided in terms of compensation. And I think recently Siegel has begun using has begun receiving pensionable compensation received during the fiscal year. And we do support their use of using that for projecting valuation pay in future years. Just one tiny comment with respect to the plan provisions. There's a $1,000 death benefit that we didn't see in Siegel's summary that we would recommend that they add to their description of the benefits that they're valuing in the plan. So most of our comments had to do with the actual assumptions that were developed by Siegel as part of the 3-year review for the period that ended June 30th, 2016. And the major focus of this would be the mortality assumptions. Siegel has probably had discussions with you about a different approach to projecting mortality, which is known as a generational projection. Typically or historically, actuaries have used what's known as a static approach to projecting mortality improvement. So what they would do is say, here's the level of mortality that we anticipate for the current population. To account for the fact that we think that people are going to be living longer in the future, we're going to project these mortality rates something like 10 to 20 years into the future with a specified level of expected improvement. Improvement being a lower level of mortality. More recently, actuaries have been moving towards using what's known as a generational approach, where you basically assume that each generation of participants has slightly better mortality than the generation before it. So somebody who's turning 60 this year would have a slightly higher likelihood of death than somebody who's turning 60 next year, right? Each generation is expected to live a little bit longer than the generation before it. I know that Siegel has moved towards using these generational mortality assumptions with some of their other 1937 Act clients. For you, they recommended an approach that still uses a static projection, which is essentially intended to approximate the cost impact of using a generational projection. And we think that's okay, but we would just encourage them to move towards that full generational approach in future years, which I think they even talked about doing as part of your experience study. So we support the movement in that direction. But there's one area in particular where we think that they need to perform a different type of analysis, and that is how do they actually measure your mortality experience? When they look at the number of deaths in your population and compare it to the number of people alive, that's what you typically do when you're trying to see how does your experience compare with some of these sort of general tables that get used in projecting your assumptions. And what Siegel has done historically and in this experience study is they compare the expected number of deaths to the number of people that actually die. And from there you generate what's called an actual to expected ratio. If your actual to expected ratio is 100%, it means that the number of people that died was equal to those that, the number that you expected to die. And typically what you'll do if you're using the static projection approach is you'll set your assumptions so that your actual to expected ratio gives you a higher number of expected deaths than actual deaths, so that you have a margin for conservatism for future improvements. Okay? In general, for pension plans, the appropriate way to measure your mortality experience is not actually to look at the number of people that die. It's actually to look at the benefits that either are continuing to be paid or are no longer being paid because the participant has died. So this is called benefit weighting versus head count weighting. And if we look at page 9, we have some bullet points here about why it's more appropriate to use an amount rather than head count. The biggest reason being that benefit amounts tend to correlate with mortality. It's probably not a surprise that the higher the benefit that you receive, the more likely you are to live longer, right? So it gives you some kind of an indication of socioeconomic status, which can be correlated with mortality. The other reason is that the pension liabilities themselves are weighted towards those with higher benefit amounts. So if you, let's say for instance that you accurately predict the number of people that die, but the people with the higher benefits are living longer, and the people with the lower benefits are living shorter lifetimes, you will be underestimating your pension liabilities if you accurately predict just the number of people that die each year. So the appropriate way to measure mortality when you're looking at pension benefits where the benefits are correlated with pay and things like that would be to do it on a benefit weighted basis. And Siegel did not perform that analysis as part of their experience study. They did discuss it. They noted, I think on page 10 we talked about, they noted that headcount weighted is the more common approach. I know within our practice we use benefit weighting. I know that other actuaries are definitely starting to use benefit weighting in other systems. I believe that Siegel has generally been using a headcount weighted approach in their California plans, but I know that the tide has turned that most people are at least measuring the impact of benefit weighting and seeing if it has a consistent impact on their plan. So we would strongly consider that they use a benefit weighted approach at the time of the next experience study. If they were to do so, and the behavior of your members looks somewhat like the behavior of the members that were used to model the general tables that they used in your mortality assumptions, you would typically get a difference in the liability of somewhere over 1%, which in your plan would increase contribution rates by about 1.3% of pay. Now that doesn't mean that that's what's going to happen for you. Your experience may be different. But if you just look at the difference between typical benefit weighted tables versus headcount weighted tables for large populations, that's something around the order of magnitude that you may expect. I'm going to pause here because this is sort of the primary finding within the audit and ask if there are any questions on this item.
We're not seeing any here.
Okay. All right, just a couple other comments on mortality. Generally, what you do, because you're a small plan, you don't have enough data to generate your own mortality tables. So what Siegel does is they look at a large-scale table and they would adjust it to your experience. Generally, to be what is known as fully credible, so that they could completely match the general tables up to your experience, you need something like 1,000 deaths. Over the period that they studied, of the 5-year period, you had only 145 deaths for your retired members.
Good.
So generally, that experience would be considered only partially credible. So they have adjusted those general tables to match your experience. We would caution them in making large adjustments to those general tables because the amount of experience that you have is actually still quite small, even when you compile it over a 5-year period. And that would apply even more so to the assumptions for active member deaths and disabled member deaths, where they made some pretty large adjustments to the disabled general tables, especially to get them to match up with your experience, whereas the number of disabilities that you have is very low. I think only 24 deaths over that 5-year period. So we would probably recommend that they do something like just use a disability table that's out there and use that without adjusting it, just because you don't really have enough experience to say one way or another whether your disabled members are healthier or less healthy than the average employee. That covers all of basically what we wanted to say about mortality. We did have some comments on other demographic assumptions. We do think that they should be looking at that vacation cash out assumption. We did, when I was with EFI, we looked at that as part of the prior audit, found that there were definitely significant cash outs that were not being reported until the year just prior to retirement. So usually you would require some kind of a load on your benefits to deal with that. We found something like a 3% load might have been appropriate, at least when we looked at it, a number of years ago. So we definitely think that's something that, we heard that Siegel is being supplied with additional information in this area, and we think they should really look at that in terms of whether that needs to be adjusted in the next experience study. The final comments have to do with economic assumptions, and we don't have any, we believe that the assumptions that you have adopted are reasonable, especially the 7% return assumption. However, in Siegel's experience study report, they have a discussion of what they call their risk adjustment. And I'll highlight this section right now. It says they have what's called a confidence level associated with the risk adjustment. And that basically means for a particular risk adjustment, it represents the likelihood that the actual average return would equal or exceed the assumed value over a 15-year period. So if the risk adjustment produces a confidence level of 60%, then there's a 60% chance that the average return over 15 years will be equal to or greater than that value. And so what they said for your plan was that if they reduced the assumed return by about 40 basis points, that would give you a confidence level of approximately 55%. So what they're saying is that you would have a 55% chance that the average return over 15 years would exceed that 7% return assumption. It's important to recognize, though, that what they're talking about there, when they say an average return, they're saying that the average return there is an arithmetic average. It's not the return when compounded over a 15-year period, right? And those are very different things. Just to simplify it, imagine if you had a 100% return one year and a minus 100% return the next year, right? You lose all your money. If you look at the arithmetic average of those two, it's zero. Minus 100% average with 100%, the average of those things is zero. But if you took a compound return, you would realize that at the end of that period of time, you would have no money, right? You would not have earned zero. You don't have anything left. So we generally tend to focus on compound returns when we're looking at pension plans. And generally with our clients, what they find is they're looking for something that gives them a better than 50% chance of achieving their assumed rate of return when measured on a compound basis over that 15-year period. So given the inputs that Siegel put into their model in terms of the expected returns from the investment consultants, plus inflation, minus their adjustment for expenses, if you look at it on a compound basis over a 15-year period, that 7% return assumption, you would really only have about a 45% chance that the compound return would equal or exceed the 7%. If you wanted a sort of a 50-50 assumption on a compound basis, using their inputs, you'd have to use a 6.75% assumption. And if you really wanted a 55% a confidence level on a compound basis, you'd have to go all the way down to a 6.25% return assumption. Now, Siegel did provide us some information as part of the audit that indicated that based on Talon's expected geometric return, so on a compound basis, and if you adjust for the differences in inflation, their expected return is about 6.9%. So they even acknowledge that there is less than a 50-50 chance of achieving that 7% return assumption on a compound basis. We still believe that 7% is a reasonable assumption. Many of our other plans are using it. There are reasons why their expense adjustment may be slightly conservative. So, if Talon is telling you that on a 50-50 basis you could get 6.9%, I would have a hard time saying that 7% is unreasonable. We just think you should have an awareness of what that confidence level that Siegel is putting in their experience study report, what that actually means in terms of the difference between an arithmetic and a compound average. We have a few other minor comments about economic assumptions. We also reviewed the actuarial methods that they use in evaluation, including the cost methods, smoothing methods, and the amortization policy, and found those all to be reasonable. So that really completes our summary of the actuarial audit, and happy to answer any questions.
We like it.
Go.
Do you have an opinion or an observation as to where we might go in the future with the 7%? I guess I'll just ask it. Do you think we're still in a mode where we'd be reducing it further?
That's an interesting question. So one of the comments that we did have in the report has to do with inflation. So one of the major things that's been driving down expected returns has to do with the fact that 10 years ago, a lot of public plans were using a 4% inflation assumption, right? You've been steadily dropping that assumption. You're down to a 3% inflation assumption right now. But the markets have been expecting low inflation, pretty well below 3% for quite a while now. And so the typical practice for public plans has been take down the inflation assumption by 25 basis points, see how that compares to what the market expectations are. If you look at it again in 3 years and the inflation expectations are still lower than where you are, move a little bit closer in that direction. So right now you're using a 3% inflation expectation. Siegel, they talked about various data sources, one of which was looked at of your consultants, which are expecting, I believe, only a 2.3% assumption. Social Security Administration, they're expecting somewhere around 2.5%. If you look at the difference between Treasury bonds and TIPS, you're looking at an expectation somewhere in the low 2s. So if the next time you're reviewing your economic assumptions, you find that 3% assumption is still significantly higher than what the market expectations are, I think it would be reasonable to consider lowering that inflation assumption again. And if you lower your inflation assumption, it probably means taking down your expected return even further.
So I have a question.
We have a number of systems that have adopted 2.75% or 2.5% inflation assumptions. So, the trend is still to drop that assumption down.
So I have a question. My recollection was that part of the reason why we stuck with the 3% inflation is because for the legacy employees, there's a COLA of up to 3%, and often it is 3%. And so that my recollection was that one of the reasons why we stuck with the 3% was that it was something of a hedge against the increased costs, as well as, you may not be aware of this, but in Mendocino County, in around 2009, 2010, the employees took a 10% pay cut, and there's been a very, very slow return to those pay levels. And as a result, the employees are paid on average about 18% less than their counterparts in neighboring counties, comparable counties. And that's created a bit of a market problem for the county, and so there's sort of upward pressure on raising the salaries more than has been in the past. And so for a variety of reasons, I thought the 3% made some sense, because we're likely to see higher salary increases than in the past. We're likely to, we continue to see COLAs that are around 3%. So for a variety of reasons, it seemed like the 3% inflation kind of made sense for the plan.
Sure. So just a brief comment on that. It is possible, so you have two different assumptions in terms of inflation. You have a inflation assumption that's basically supposed to be like CPI. And then you have a wage growth assumption. So how much are base wages expected to grow? And usually, public plans assume that wages will grow at the rate of CPI or higher. So frequently there's a margin between the wage growth assumption, which is known as the real wage growth assumption, and the CPI assumption, or just base inflation. So right now, Siegel is I believe they are recommending a real wage growth assumption of 0.5%, which means if you have a 3% inflation assumption, that wages will grow at 3.5%. So even if you were to drop your inflation assumption below 3, you could still keep that wage growth, the real wage growth assumption of 0.5%, which would mean that your wages are still expected to grow at faster than 3%. Or if you thought that the wages were going to grow over the long term and even higher than inflation, you could adjust that real wage growth accordingly. But it's good to know that there are two pieces there. There's base inflation, which is basically CPI, and then there is wage growth, which is on top of that. I do know that you have had CPI. I know that as part of your COLA, your COLAs are tied to the Bay Area CPI, which again is kind of strangely bucked the trend of everywhere else and been close to 3% for a lot of the past few years. But over the long term, generally we expect, there's not a great reason to expect that Bay Area inflation is over the long term going to be necessarily higher than U.S. inflation overall. And the U.S. overall inflation expectations are still significantly below 3%. So, in general, we do think that 3% is a reasonable assumption to use. It is on the high side compared to market expectations. So when asked the question, in terms of what direction do we see things going in the future, that's one thing where there is a clear difference between market expectations and the assumptions you're using. And if those differences continue, that's an area where we'd expect to see that assumption come down over time.
Andy, I have a question on our 5-year smoothing.
Okay.
Is this what you see as kind of an average from other pension plans? I mean, I know.
Yes, that is definitely the most common smoothing period used by public plans in our experience.
CalPERS accepted?
CalPERS has actually moved to a 5-year phase in and out of investment gains and losses. So they use a slightly different approach, but it's similar to your 5-year phase in, or to your 5-year smoothing.
They were at 17. Yeah.
That's their amortization period.
Oh.
In terms of the asset smoothing, a 5-year, which you're using a 5-year period to smooth in investment gains and losses, CalPERS uses something known as direct rate smoothing, but they are also like phasing in the impact of investment gains and losses over a 5-year period.
Good to know.
It looks like there's no other questions for Chiron. I did want to give Andy and Paul the opportunity to address and comment, make any comments.
Thank you. This is Paul Angela. Can you hear me okay?
Yes.
Yeah.
We really concur with all of Chiron's report. Very pleased about the match on the numbers, which we think is sort of the core purpose of the actual audit. On the assumptions, you will definitely be seeing generational mortality, and we will also be looking at the benefit weighted that Graham described. And on the expected return, there is a difference. I think the approach that we use, which is based on expected arithmetic returns, it does reflect that volatility effect that Graham described, but we are going to refine the way we describe it in our report. To say that we're focusing more on variations around an expected value of zero to surplus and zero underfunding, as opposed to a 50-50 median. But we will clear up our text in the report on that. Other than that, though, especially for demographic, and we agree that the price inflation assumption is very likely going to be coming down. This year, we are recommending 2.75 for the systems that are doing reviews this year. And so we don't think that you need to change that out of cycle. That will be part of our recommendations going forward as well. But all in all, we concur with virtually all of what Graham's presented, with the understanding that the arithmetic geometric is something we have discussed with you in the past. Andy has a comment as well.
Yeah, the only comment I have is with respect to the $1,000 death benefit. I think this is one of the reasons why you go out for an audit, because when we first set up your account on a management program, we relied on the evaluation reports that your client actually put together. There's no mention of the $1,000 death benefit, even though that benefit has relatively small contribution rate impact, but nonetheless we thank Chiron for pointing that out, because we will be including that in our next valuation.
Very good. That's all we have. Thank you.
So I have a question for both groups. So on table 2.4, which is on page 7, on that table it shows that the disabled retirees are 174, the service conventional retirees are 1,135. So that 174 is 15% of the traditional service retirees. Is there any I didn't really see any information in the report. Is there any information that you have that shows the cost of the disabled retirees versus a conventional retiree? And what I'm thinking of is in terms of, I realize that part of the benefit is that much, if not all, of the retiree benefit is exempt from state and federal income taxes, which does not affect the plan. But to the extent that a disabled retiree receives a higher benefit because it's, I believe, a minimum of 30% of pay, regardless of length of service, does the disabled retirees how do they affect the plan, and how is the plan accounting for their costs? And are we seeing any kind of increase in the claims, not necessarily specific to our plan, but just in general? Given the fact that not all disability retirements are based on an injury, a workplace injury, but sometimes, as we've seen here, they're sometimes based on a stress disability, which is a little harder for the general public to understand, but because it's somewhat unusual in the private sector, but it exists in this plan. And so, so those are kind of my questions. How is disability retirements, how are they factored into the cost of the plan? And should we be accounting for any growth in costs there?
Okay, well, go ahead, Graham. Go ahead. I was going to say, I think Siegel's probably better, they can answer this question for your plan. What we have found with the plans that we work with is actually somewhat surprising, in that we have seen continually declining disability rates among our 37 Act counties. So we've been using lower and lower assumptions in terms of disabilities, which really has made the impact of disabilities on the cost of the plans that we work with sort of lower and lower over time. But Paul, I think you're probably better suited to speak to Mendocino's experience.
Yeah, I think we measured the number of disabilities during the last experience study. actually, our observation at Attempts there is slightly different from what Graham has observed at other places, because we do see an uptick in the number of disabilities. For example, we expect 17. The actual number came in at 19, but I question whether or not that is because the fact that we have a relatively small size of active workforce.
Yeah, back to Graham's comment on credibility, 17, 19 is just a statistical blip. But to the question, we review the disability incidents at every experience study. So we are tracking the actual experience of Mendocino and comparing it to itself over time. The first one is stress that it is definitely one of the demographics that we measure with every experience study. I don't think we've seen a wholesale trend one direction or another. And the other thing is that, even though we do not break out the cost of disability separately in our report, we have a couple plans who just for historical reasons we do, but it's kind of a misleading statistic because, that we would include as the cost of disability the benefit for anyone who becomes disabled. Even if that person essentially gets the same benefit that they would have gotten as a service retiree, because they're categorized as a disability, that's where their costs are put. So when you look at that statistic separately, it gives the illusion that if it says that of your normal cost, pick a number, 4% of pay is due to disability, that doesn't mean that if you eliminated disability, your costs would go down by 4%, because most of those folks would still be getting a service benefit. And as the questioner pointed out, this is as much about a tax advantage as it is about a substantive larger benefit. But we have not priced separately what the impact is on members who not only get a disability benefit, but they're young enough that they get a benefit larger than their service retirement benefit would have been. So don't really have the statistics on it, but it may not be as material as you think, because as the questioner observed, so much of it is really a tax benefit rather than an additional income benefit.
I would say that, like, in terms of Mendocino's experience, when we just looked at, Mendocino did provide us with their expected results by decrement, so, versus service, retirement versus disability, and even include, recognizing what Paula just said about if you got rid of the disability, they would still get some kind of a benefit. It's even on that basis, it's still less than 10% of the assumed liability for your active members.
Very good, agreed. Yeah.
It looks like we have no other questions or comments here.
Great. Well, thanks very much. We appreciate the opportunity to work with you, and we also wanted to thank Siegel for all their cooperation.
Thank you.
And we express the same to Chiron. Very effective, and I thought a very productive project all around, and Chiron is always good to work with.
Very good.
Thank you.
Thank you both.
Thank you.
Thank you all. Bye.
Bye.
That was smart. So, is there going to be some kind of a press release or something on this? I'm serious.
That would be good.
Yeah, I mean, I don't know what we could do, but I mean, I think it would be nice to even send it to something to the paper, the journal. I don't know if they'd run with it, but they could.
Yeah, they could.
Which part of the plan of the study do you want to emphasize? The 45% probability that we'll meet?
No, just the fact that they didn't find any, that they, basically our actuaries performing well, because, I mean, after the buck, that was a mess.
Sometimes no news is good.
No news is good news.
Sometimes no news is good.
Well, and you know what, I guess too, it would be something that could be used down the road if we did, say, if the critics did start in again on something, we could say we've done we've done an actuarial study.
So am I the only one who's concerned that using the compounded, it's only now 45% chance that we're going to hit our mark instead of the 55%?
Yeah.
I did note that too.
Yeah.
If I may, Mr. Chairman, I disagree with them on their 45% chance. I don't think that's accurate. And it all comes back to what is the appropriate historical rate to use when forecasting. Is it the geometric return or is it the arithmetic return? And Chiron is saying that they believe it's the geometric return. Siegel is saying they believe it's the arithmetic return. I have reviewed the research, not extensively, but I've looked at research articles on this very question. And the conclusion that I come to is both estimates are biased, but the arithmetic mean is less biased in general. So it's the better measure moving forward. Neither is perfect, but the arithmetic is better on a go-forward basis than is the geometric. It's just the way the numbers work. So I know it's easy to say you're ignoring compounding. Well, you have to get into a lot of details and understand a lot of time series and forecasting and econometrics to really work your way through the research. But that's where you end up is the arithmetic mean is a less biased estimate of future growth rates than is the geometric mean. So that's my review of the research. And that's what Siegel has said, and that's why they use the arithmetic mean. I'm not sure what other actuaries do. Chiron says they prefer geometric, but I think the arithmetic is a better approach based on my review of the research.
I mean, the difference between the two is a 55% probability guesstimated by Siegel, and the geometric guesstimated by this firm, Chiron, is 45%.
So let's go 50.
Well, Chiron didn't really do an estimate of that. They simply took Siegel's methodology around this risk factor adjustment and getting to the 53 or 55%, whatever it is, and flipped it for using the geometric mean. So instead of having a 55, they said your difference is this. If you flip it on the other side using the geometric mean, you're actually at 45. So they didn't Chiron didn't do an estimate of that using a Monte Carlo simulation or something like that. They merely took Siegel's number and flipped it, is really all it is. So it really all comes back to what's the best number for going forward, in my mind, what's the best number for forecasting? Geometric mean or arithmetic?
Yeah,
So.
yeah.
Well, I just had a question regarding this, just if we know what other systems are using, because I know it's coming up later in that report, but we are on the more conservative side, it seems, among systems using a 7% rate. So would that imply that most systems are using arithmetic, or can we not read into that?
I'm not sure you can read into that.
Okay.
Every actuary has their own methodology of what they use and how they develop their recommended rates of return. I'm not sure that a lot of actuaries actually get into the level of detail of the difference between arithmetic and geometric.
Mm-hmm.
I think a lot of actuaries probably just take the number from investment consultants and use that without really thinking about how it's calculated and what it means. And there's some comfort in doing that because you're delegating the decision then to the investment consultant and just relying on them. And if something goes haywire, you can blame the investment consultant or the investment consulting community because you used their numbers. Whereas Siegel, I think, is going above and beyond and really thinking through how are these numbers developed and what do they really mean. So
know how many of the 1937 Act counties have used Siegel as their actuary?
I do not know that number.
There's quite a few.
I know it is,
Over, that's what
I was gonna say, I think it's
Yeah.
half,
Yeah.
Yeah,
in the vicinity of half.
Yeah.
okay.
There's a roster out here that shows it. We get a roster every year and it shows who uses what consultant and what money manager.
I think the 1937 Act population is going to be covered by 3 firms, Siegel, Chiron, and Milliman. I'm not sure if there's any other, it may be only those 3 that cover all of the 37 Act space.
So Chiron is reviewing Siegel's actuarial, and do they do the opposite? Does Siegel, yeah, so it's sort of like a peer review.
Exactly.
Mhm.
Yes, yes.
So we've heard that other agencies, you know, the headline figure is they picked such and such as their investment return. And the rate of return is the number you normally hear. Do we have information about what the other plans have in terms of their background inflation number? Because essentially we have a 4% net over inflation when we've got a 3% inflation baked in. It'd be interesting to see that, you know, what's the net over inflation that everyone else is going with.
I've seen those numbers, I don't recall what they are. I know in the report we'll look at later, there's 2 sets of assumptions that I kind of point to. There's the assumed nominal rate of return and the assumed inflation rate for that population, that RVK samples. I think if you look at real rate of return assumptions, so nominal return minus inflation, I suspect the distribution versus for real rate of return assumption versus nominal rate of return would narrow. So what that tells you is a lot of people still have higher inflation rates, contributing to a rate of return assumption of 7.5 or 8 or even 8.5%. And if you look at their real rate, they're probably 5 or less. I think most real rates of return are probably going to be in the 3.5 to 4.5 range. I don't know the numbers, but I think that's going to be a lot more compressed. Whereas nominal rates, you're seeing anything from 6, maybe as low as 6.5 at this point, all the way to still 8.5. So.
Did you have a question? Well, one final thing. So in the report, they talked about the trying to get more information about the cash out of vacation time. And did Siegel address that? I didn't really see them address that in their response.
Well, we've been working on that, and part of it is with better data availability and reporting to the actuary. The actuary is getting all of the compensation earnable and pensionable compensation each year. Previously, we would simply give the actuary one payroll cycle of data, and then they would multiply that by 26 across the population. But now they're getting full reporting on that, so they're more likely to pick up those vacation cash outs along the way. But we do still see those increase at the end, and we'll have further discussions with Siegel about that, making sure that we're aware of that and picking that up. So,
does vacation cash out exist for the Pepper employees or only the legacy employees?
it exists, but it's not part of, it's not pensionable for Pepper employees. So it still exists in the MOUs, but it's not included in pensionable.
And then sick leave converted to time served, that's not capped in Mendocino County for the Pepper employees?
That's not capped for any of our members.
Yeah, well, I knew it was for the legacy.
Right.
So it's not capped for the Pepper employees?
Correct.
I've heard of some other counties where they've capped it at, say, 6 months accrued. You could accrue a year and a half of sick leave and use it, but in terms of getting credit for time served, in the case of Tulare County, I think it was capped at 6 months.
Okay. I don't believe it's capped here. For Pepper.
I should add something, since we're talking vacation buyout, and there's people that don't work for the county that may not be aware, we're not talking about any, like, 300 hours that you accumulated during your working career and you get paid that when you leave. We're talking about the ability to turn in 80 hours a year. Some people might be confused and say, wow, you had 300 hours, you got paid for it at the end, and your pension is based on those 300 hours, or 300 hours per pay. It's not. It's only the amount you can turn in while you're still working.
And so an employee, if they knew they were going to retire 3 years from now, might cash out 80, if they had a lot of crew, they might cash out 80 hours for the last 3 years of service.
You can only do
Well,
one
you also
year.
have
And
to have a huge
they do
bank.
it in they make it so it was in 1 year, yeah. I mean, they do it like 6 months, yeah.
You're limited though to what's been earned and payable in that year.
Right. And based on leave accrual currently, the most that any employee can cash out in a year, is it calendar year or fiscal year, or is it 12? I can't remember. In
I don't
a year,
know.
whatever the definition
I think
is,
it's a 12-month period.
is 200 hours. So, because that's the most that anyone can earn in a year is 200 hours.
And I think it was different for the 1 year, the higher tiers where it's just 1 year as opposed to 3 years, because
Right.
I know 1 year, that's what they were doing, is they'd cash out the last towards the 6 months, and then they do it again in 6 months, and then that would be in their last,
Right.
that would be in a year,
Right.
highest year, so they would actually get to use, like, whatever it was, 80 and 80, which would be a pretty good
Right.
benefit, so. And it also seems like HR, as far as the data, it seems like it would be there. It seems like that, because it's a particular, I would think that vacation, it's a particular code in payroll, so it seems like that data would be able to be captured. It's just how would you get that into the experience, and you don't know what they're gonna do, who's gonna retire going forward, and
Right.
how much vacation they might decide to go on a big trip before and not cash out their vacation, right, so.
Why would they going to retire?
True.
We get that in the payroll transmittals every 2 weeks. We
Uh-huh.
know, if there was a vacation cash out and whether it is included in pensionable compensation or compensation earnable, whichever it is for legacy members, and we get the contributions on that. So we're capturing that data now, just like we do everything, uniform allowances and vehicle allowances for legacy members and all those kinds of things, so.
I had a question I was looking at the reciprocal pay increase and just trying to get a little bit more information on how many people would be in a reciprocal system. And in the experience study, it said 60 to 65% of future vested employees would be. I think a lot of that has to go with the fact that people are leaving for higher paying jurisdictions. Sonoma County, I know, pulls a lot of our staff. If the Board of Supervisors, was able to follow through with a wage increase after this compensation study and fewer people start leaving, I know it would take kind of years to get a picture of that, but could that have any measurable impact on our future if we had a considerable change in that field? If we got more on par, because everyone's leaving for higher pay. If our pay balances out, they stay here and contribute. Is that better for us?
It depends.
Okay.
There's a lot of things, a lot of moving pieces in that. And I can't think my way through to get to an answer definitively right now. But you do have to think about if there's a significant pay increase, that might mean you're better able to retain people and see less people leaving for reciprocal service. But you also have to think about what that pay increase means right now.
Right.
You know, you're going to see increasing contributions because of the pay increase, but you're also going to see increasing benefits because of the pay increase. So there's a lot of moving pieces to think through, and I can't get it all.
Yeah,
Off the
and
cuff.
on that, that's what happened when the retiree health insurance was taken away, is you had a lot of people that would have retired maybe at 57, 58, but instead they worked to 65, and we see that now. There's people that, some, maybe they've had cancer or whatever, they didn't retire, they stayed working for the county, making a higher, typically working up still, making a higher salary and working till they're 65. So things like that definitely affect, yeah, the outcome. All different
Yeah.
factors.
You also, you would, with higher, with a significant salary increase, I think you'd see delayed retirements, which reduces your costs now, and you have to think through it.
The average 3-year.
Yes.
I just have a question on, since it mentions the tax benefit of a disabled person not paying taxes, and at CalSTRS I've said that, you know, you pay full taxes if you're disabled. Who makes that decision, and or when was it made?
That's a IRS franchise tax board decision. It's not a retirement or employer decision. So I'm surprised to hear that it's different under a different system. I just
It
assume
is.
that's the tax laws.
Yeah, no, can't be, because
I believe that it is.
CalSTRS
It
could
has to
do.
do with the IRS considering a disability payment of workers' comp.
Right, that's what I had thought.
And so, and workers' comp is not.
That's why I'm surprised to hear that some other entity can do it. It's done,
Yeah.
treated differently.
Has done it forever.
One is a benefit and the other is a settlement.
I'm surprised to hear that. If you're interested, I can try to find out the answer.
Yeah, just me, so you don't have to get anything
Sure.
else from me. Yeah.
That's
STRS, do you know about PERS?
I don't know about PERS, no.
CalPERS, there's a tax benefit.
don't
It's a tax benefit to get a disability pension, from
No
what I
taxes
heard.
paid?
Well, it's a reduced,
Reduced.
there's a whole different set of criteria, right, based on percentage disability. I don't think there's a clear answer.
Continued disadvantage to teachers.
Absolutely, yeah. Injured on the job. And
No justice.
no, there isn't. It's our big salaries, we really don't need
That's it.
these things.
Yes. Okay. All right, so we'll go on to item 5, which is the quarterly budget update.
Thank you, Mr. Chairman. Trustees, you have the quarterly update before you. We are 3/4 of the way through the fiscal year. And I focus on the year-to-date numbers, as I believe those are better indications. Year-to-date total administrative expenditures are up versus last year by almost $73,000. And you can see the most significant increase was in personnel expense. There was salary increases for staff as well as supplemental payments that were bargained for. We have an uptick in disabilities versus last year. And in the investment space, investment manager fees are up because our new managers were paying directly rather than having those fees netted. When you turn to Schedule 2B, looking at year-to-date versus budget, we are under budget by $78,000, just about 10%. The savings there, we're under budget in legal expense quite a bit. We increased our budget there, planning for some projects and other things. And we're just starting to get those projects to the point where we're spending money on legal services and various other changes. I'd be happy to answer any questions you might have about specific line items or anything else about the FY18 budget.
not seeing it, we'll go on to 6, which is discussion of possible action regarding audit and budget committee report.
Yes. The Audit and Budget Committee met immediately after our regular board meeting last month, and we went over the proposed budget, not exactly line by line, but we did hit the major changes. And we come back with a recommendation that the board adopt the proposed budget.
So that's a motion essentially from the committee, right? So we don't need a formal motion from the board.
Right. Correct.
Any discussion on the motion from the committee? Okay. Involves money, so I probably do roll call.
Okay. Ms. Shatmeyer?
Yes.
Mr. Sullivan?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Ms. Smith?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Chair Judy?
Yes.
And Mr. Walker, give him just 1 minute.
Okay.
Just come in.
Just so you- Mr. Walker?
Just say yes. That's
Yes.
what Kathy said.
Unanimous.
So we just approved the proposed budget for 18-19.
So you know what you did.
Yes.
Okay, 7, which is
Second.
discussion and possible action regarding direction to MCR voting delegate for the association meeting.
Thank you, Mr. Chairman. Trustees, you have a memo and the SACRS business meeting packet before you. There are 2 items at the SACRS Board of Directors meeting, or business meeting, I'm sorry, requiring a vote. And you have a memo there explaining the items and giving you a recommendation. I'd be happy to answer any questions that you might have.
Do we need a motion?
Yes, we do.
I'll make the motion that we approve. It's
Second.
written.
We have recommended, nice recommended motions.
Are you making the recommendation that's written?
Yes.
Okay, so we got a motion. Any discussion on the motion?
Just for clarification, if I may, Mr. Chairman, I wrote this with 2 separate motions. One for the legislative committee and one for the board of directors elections. Is
It's the motion to move both motions.
is the motion to move both motions?
It is.
Okay. Just making sure we all understand exactly what we're voting on.
Except for the treasurer or the secretary recommendation.
Okay, so all those in favor?
Aye.
Any opposed? Okay. So that takes care of 7, doesn't it?
Yes, it does.
So then we're on to 8, which is,
I do just want to make a comment that looking at the officers, I'm just very pleased that Mendocino County has a rep. They're all from large counties.
They're all
Mostly
small.
Southern California too.
Yeah, I mean, we're the smallest county out of the 20.
Yeah,
Yeah, so it is nice.
yeah, that's great.
Yeah, it's, now the vice chair is Westero, LA County, which is is the biggest.
Good. Keep up the good work.
Yep.
Thank you.
Yeah, how you like it?
You know what, I wish I had more time to spend, and it's like, as of January this year, I have just been inundated with my job, like just bombarded, and hopefully now calm down a little, because I'd like to spend more time.
I mean, those are demanding, those posts.
okay, the next item is 8, which is the scheduling of the fall coastal meeting. And we got our packet. We're looking at change from July to September.
I recommend a change.
Yeah, I think
I move to
I'll
change it.
second that.
Okay. Got a motion and a second. Any discussion on the motion?
Just for, if I may, Mr. Chairman, for full clarification, indicated at the bottom there, we will be having the meeting on the coast and the start time will be 10 a.m., not 8:30.
Yeah,
So,
thank you.
Thank you.
Thank you.
And it's all one day.
yes,
Yes.
yes,
And what day is that?
September 19th.
Okay, got a motion on the table. All those in favor?
Aye.
Any opposed? Okay, now we're on to 9, which is discussion possible action regarding the retirement administrator report, retirement administrator evaluation.
Thank you, Mr. Chairman, trustees. 3 items on the administrator report, the evaluation. The forms have been emailed to you along with the self-evaluation. The chairs asked you to return those to him, your evaluation by June 1st,
When they emailed?
this morning,
Oh,
Because
okay.
I didn't.
Like I said, I mean, I'm not usually all that up on my emails, but
about 7 a.m.
I usually pick that up.
I also attached the RVK Public Fund Universe Analysis. It's reviewed at SACRS every year. I did point out in my report the information on actuarial assumptions on page 69. I thought that was interesting that in that report they capture actuarial assumptions on both assumed rate of return and I think inflation. And we're on the conservative end of both of those, I believe. I know we're on the conservative end for rate of return assumption. And then the SACRS legislative report I've attached, and I did screen out, so I cut the bill list in half by getting rid of anything that was dead or already enacted. So, and I'd be happy to have Jeff answer any questions on anything there that you have questions about on legislation.
Not a question about that, but if I remember correctly, when I went through the RV Kuhn report, Mendocino County for the 1-year return for the overall fund was number 3 out of the whole universe of the systems that were considered here. We're number 3, and we're in the top third in all the years that they talked about.
You put that in your press release.
Yeah, I was gonna say, that's the lead in.
Was it on page 69, was it of that Coons report, is that third piece of data, is that what Dan was looking for earlier?
Yes.
Okay.
Yes, that is accurate. I forgot.
Oh, yeah, so
that
the rate of
existed.
return minus the inflation. So the median is 4.4. According to that.
Yes. That is correct.
So the number at the very bottom of that chart, that's showing we're the green, so that's showing our assumed net return after inflation is 4. Okay, correct. Then you can see.
The middle chart on page 69 is salary growth, it's not inflation. So that's why we show up in 3.5. Our inflation is 3, but we assume salary growth of 3.5.
So a net of 0.5% above our assumed inflationary.
Yes.
So somebody has an actuarial rate assumption of 8.45.
Yeah, who's that?
Isn't that crazy?
I do not.
It's the,
Very optimistic.
It's the Reno Casino.
There you go.
We'll find out.
Maybe they have money on the Vegas hockey team. Quite a payoff for detention.
There you go.
Okay.
Yeah, unfortunately, no.
We could invest,
Oh, you might?
we could invest in lottery tickets.
Okay, you've already referenced your SACRS report, legislative report. Is there anything else you want to add?
Money goes to schools.
I'd answer any questions.
That'd be nice.
Oh, it's your social investment.
And there you go. For entertainment purposes only.
So do we
Throw it.
before we go to
For
closed session,
entertainment purposes only.
before closed session, do we have any board general discussion items?
This is not, now kind of general. when we're going through these on the tablets and someone refers to page 69, is there a way to get there without doing all the scrolling?
At the, so when you're in a PDF document, which most of these are, at the top, you can see a box with a number in it, and next to the box is a slash and then another number.
Okay.
So if you highlight that box, and then you can input the number that they're referencing, and that will get you close to that.
Okay.
So,
Yeah, that would be helpful.
Well, I found that I can do that with the RVK report, but with some of the other reports that we reviewed, maybe they weren't PDF docs, because some of them I did have to go, you know, so I guess we could,
Might be the version of Acrobat that they use.
it could be.
And another thing that would be helpful on, you know, maybe some of the stuff that comes from us would be if there would be a page number at the top of the page instead of just at the bottom, you know, so you can tell. that-
Usually you go find a page, then you go back up.
Yeah, yeah. So, other than that, I love having these and not laying around a bunch of paper.
Did we get your stool also?
No, I don't, I've been sitting here with my feet dangling off the edge since we first
This is
started.
handle right
And
here, I had to hit mine.
Okay, and I keep losing my shoes, so that's what I'm doing under the table. And it's hard to put them back on.
Okay, well, so at 10:52, we'll go into closed session for Catherine Johnson, Court Services Technician 2, Service Connected Disability Retirement Appeal.
How many people we have going to SACRS?
Voted unanimously to approve and adopt the hearing officer's recommendation in the Catherine Johnson case to deny her application for disability retirement.
Okay, with that, we're going to adjourn at 10:59.
All right.
Yay.
Good.
So no response.
Nice work, Mr. Chairman. Get us out before 11.
Good job.
Who knows how to value